Welcome to my favorite video of the month, obviously. You know we're talking about stocks to buy. And, well, I've got 4 stocks today, so I hope you're ready for a long one. That is what he said, I guess, So we're going to talk about 4 stocks today that I think are buys. There are many things to think about, obviously, when we talk about looking for stocks. For one, obviously, this market is a pretty weird, volatile market. Typically, the summer months are very weak historically in terms of performance for the market, so they're usually the weakest months. So that is one thing to consider as well. There's a lot of stocks that are, in my opinion, not that great of buys out there. So we're going to be looking and just really finding those that I think are good. We're going to start off with really one that, it likes to stay on this list, and it's going to be Facebook. And you may be questioning with a stock that's at its all-time highs, how is this making the list? Well, there's many reasons for Facebook making this list. I think for the most part it goes without saying. So obviously you see historical performance. Year to date, this thing is actually performing pretty well, up 12%, which is beating the broader market in general by a good bit. But there's been a little bit of turmoil here since 2018, all things considered. We touched these near highs. Really only up around 12% from those highs back in 2018 too, which doesn't quite seem fair for a stock that is, a company that's been growing at the just rate that this company has. First to describe Facebook, obviously you know the name Facebook for the platform. This is a company that also owns Messenger, Instagram, Oculus VR, and WhatsApp. Obviously, most notably, one of the most downloaded, really the most used app as far as social media. Most popular right now is going to be Instagram, no doubt, and it's just growing consistently. So it's just going to continue to grow. Instagram is going to be massive, and you talk about monetization of the platform. There's a lot of money that can be made in Instagram. Obviously, Facebook Messenger. I don't think a lot of people think about this, but with everything going on, Facebook Messenger offering a video call feature is pretty massive, and I think it probably will get more people using the platform, actually. So very interesting in that aspect, as we've seen every other company show massive growth in terms of video conferencing platforms. I think Messenger is going to do the exact same. You have Oculus VR, the leader in virtual reality technology as far as gaming is concerned. And when you think of VR, you think of it's going to be a major facet in gaming in the future. Major. And obviously video games aren't going anywhere. Gaming is not going anywhere, and virtual reality is only going to become a bigger part. So Oculus is leading the way right now, and I think they right now have the best virtual reality system out there, and I think they're just going to continue to rock it. And WhatsApp is still just a lot of potential here in WhatsApp, so very, very good potential for WhatsApp as far as how they're going to boost that in the future. Obviously, talking about just the Facebook platform, people don't think about it maybe, but when you look at it, Facebook daily active users continue to grow just rapidly. We talk about just rapid changes from quarter one of 2018. You see 1.4 billion daily active users to now, quarter one of 2020, 1.7 billion daily active users. That's massive growth. And the monthly active users, guess what? It continues to grow as well. 2.1 versus 2 years later, 2.6. That's very big freaking growth. We also see growth in the average revenue per user for this company. And as those numbers continue to really accelerate, you see growth in really their revenue. It's a company that grows revenue like no one's business. Just look from an aspect of revenue on this company. In 2016, making $27 billion to now in 2020, on a trailing 12-month basis, making $73 billion. And you also need to look at the net income line, right? That net income line, as highlighted here, it continues to increase, right? This company prints cash at just an absolutely abnormal rate. They make money. And really, if you look at the growth potential of this stock, it's just doing great. Next year expected to grow 24% in terms of revenue. So they're expected to do $96.7 billion on an average estimate basis next year. That's just massive. This year expected to do $78 billion. which is 10% growth year over year. Obviously, there were some slowdowns for many reasons, ad rates declining, but everything will be good by 2021, and they're going to continue that path of massive growth. Really, they've been doing just fine as is, but we also see EPS continue to accelerate. Last year, $6.43. This year expected $7.57, and next year expected $9.81, which means profitability only goes up. It's crazy for this company. They are doing great things. And finally, I would like to talk about, obviously the fact that they've opened, that's right, shop features. The shops features on Facebook and Instagram is a big deal. So this allows, obviously, people to purchase items right from these creator shops, which not only brings massive revenue boost to Facebook, but it's beneficial for these influencers and creators as well. Obviously, one thing really cool about this too, they are partnering with partners like Shopify to make this happen. So very cool on that aspect. So it benefits both companies. And they also made a big investment in Geomart. I'm sorry, I can't pronounce it. But they made a $5.7 billion stake here in this company. And this company is launching online grocery services over in India, which again is just a massive, the demographic there is crazy. The amount of people in India, it's so densely populated that frankly there's a lot of people that this can reach. So really, Facebook is one of the most diversified tech companies out there. Now they're potentially getting into partially the online grocery business. What else can they do, right? All right, that's it for Facebook. Again, I think it'll just continue to perform over the long term. It's going to be one of your best stocks in the next 5 years that you can see. Next is a one that I don't think people think about a lot, but I'm going a little bit more boring here for the second one. It's going to be HP. So specifically HPQ, as opposed to Hewlett-Packard Enterprises. I prefer this split of the company a little bit better. This is a stock year to date that is still down around 18% on the year. And I think it's unfair that it's down that much. I think there's a lot going for this company. We think about HP and what they have to offer. Well, so HP, you think about the fact that right now, stay at home is massive. People are building home offices like never before, because of the fact that really employers are encouraging people to work from home just due to this pandemic. So HP is going to gain a lot of business on their laptops and desktops. Not only that, obviously they have printers. Printers is just going to be a massive business as well for them. It's kind of what they're known for, but really their laptops, desktops, everything. HP is great for home office. They really are. And one thing as you can see on the top of your screen here, is 3D printing. I'll click on that and see what it'll bring me here. But 3D printing. And I bring this up for one main reason. So you look at, really this is the total addressable market for 3D printing in the future. This is a market that is expected to reach $40 billion, over $40 billion in terms of value by 2024. Right now valued around $16 billion. That's good growth, absolutely massive annualized growth rate for 3D printing. And in the future, it'll only become bigger, right? And HP has a good chance, a really good opportunity ahead of them to be very successful. 3D printing is going to take over, and HP is a good time, a really good chance to be part of that. As far as just what the stock offers too, I wanted to mention the dividend. I think it's very nice to mention. It's a stock that has a payout ratio only of 34.13%. Minor, very small payout ratio. Currently yielding 4%, which is very nice, by the way. It's a quarterly payer. Dividend growth, history of 9 years. And really the reason for that, it has been a consistent dividend grower. But if we look at the chart here, they kind of paused that from either year 2000 to 2009, so it wasn't necessarily recession or anything that caused this sort of decline, right? It's not what stopped them from growing the dividend. It's just the company decided not to at that time. But for the past 9 years, they've been consistently growing it. And with the payout ratio so low, I think they're going to continue to grow it. So I think they're going to continue to grow it. The yield is consistent on this company, and it's just a consistent dividend payer for you. I don't think it's a bad addition to anyone's portfolio, honestly, in my opinion. So if you look, obviously this is not a company known for massive growth, but it is trading right now at a forward PE of 7.5. Now, if you see undervalued, I think you think about this, right? Again, the company doesn't have massive growth, but a PE ratio of 7.5 or a forward PE of 7.5, trailing PE of 8.5, that's dirt cheap valuation for this. Price to sales of 0.44. I mean, come on, guys. This is dirt cheap valuation. Dirt cheap. As far as growth's concerned, again, we look at this and we don't see a massive growth story, but you do see growth, right? You do see growth overall for this company. In fact, expected growth rate this year is going to be negative. They're expecting a negative growth. Not awful, but you're also expecting next year a growth of 2.1%, so they're going to return to growth. I don't know. The company's got a lot to offer in terms of what the stock offers. EPS is expected to grow. This year, we're expecting a little bit of a decline year over year, but next year, expected to return to growth in EPS, which, that's right, it makes that forward PE even a little bit cheaper. So that's why I think HP is a great pickup right now. I think there's a lot of opportunities for the stock and what it can offer you. So I'll be looking at picking up some of these shares, no doubt. Next is, oh my gosh, I'm sorry, it's another boring one, right? It's another relatively boring one in CocaCola. And you look at this, and who recommends Coca-Cola? It might be what you're thinking. Year to date, I think it's slightly unfair. The stock's down 18%, right? The stock's down 18% year to date, and it's a company that, for the most part, doesn't get that massively impacted by current situations like this. First, we'll look at what the company is. Obviously, you know Coca-Cola for the Coca-Cola name, but we think about Sprite, Fanta, Dasani. I don't like their water, but Smart Water, Minute Maid. I mean, these are brands everyone knows. These are very big brands. Innocent, don't know about that one. Simply, Georgia Coffee, Costa Coffee, Fuse Tea, Honest Tea, Fairlife. You know their chocolate milk, Powerade. The Powerade Zero is better than Gatorade. Just saying. Seal, Schweppes. That's right, Schweppes. These guys make tonic water, and I hate tonic water, but vitamin water, Gold Peak Tea, Zico Appletizer. This one's a wild one for me. Topo Chico, Aquarius, Addis, Fresca. That's right, Fresca, the thing that actually tastes like battery acid. Or is that, is that Fresca that tastes like battery acid? I think it does. Aloha's, Ayataka, Barks. Oh, that's right, the root beer, baby. Doga, Don, and Peace Tea. A lot of teas for this company, but, I mean, this company has a lot of brands to it. A lot going on for this company. So, we also talk about the dividend this company offers. That's right, this is a dividend king. 57 years of growth on this dividend. Are you kidding me? Currently yielding 3.6%, which is pretty high historically, and we see a payout ratio of 87%. Is a little high. I don't think they're going to completely break their streak of dividend growth, though. I really don't. Even though that payout ratio is high, I'd like to see them lower that. But I think the dividend growth is still going to continue year after year. It's a quarterly payer. Very nice dividend on this company. That is definitely one thing I can say. So we look at the company, obviously, valuation-wise. Trailing P of 19, forward P of 22.6, which is relatively fair as far as market valuation is concerned. But I do think there's potential here. I'll get into that in just a second. We look at revenue estimates, expected 8.9% growth next year. This year, expecting a 10.0 or 10.9% decline, but next year expected back to a growth there. EPS estimates supposed to be the same as what we saw last year as far as next year's concerned, and this year expecting a decline as well, and not a shocker at all due to just the current environment. And one final reason why I think this is a good pick is I don't think people think about this, but investors flock to safe stocks when the market's uncertain. And I think over the next couple months, the market's going to go back into a pattern of uncertainty. And there are certain stocks that benefit. You talk about consumer staples, typically they're best as far as performance goes, but we also talk about dividend payers. Dividend payers tend to outperform the market for the most part. if you look back at the stock, and that's right, we'll go max on this and take a look at the recession in 2008 into 2009, the financial crisis. This is a stock that went down, if we want to be fair, let's find a good point, around 40% in a time in which the market went down 60%. So think about a company like Walmart, think about a company like CocaCola. These are the consistent ones that everyone knows. They pay a dividend consistently, and the investors can just sink their money in this and let it sit, and they know it'll be safe. Investors don't want to be out of the market. They really don't. So usually they park their money somewhere safe, as in a Walmart or a Coca-Cola. That's why Walmart stock's been going up so much. And Coca-Cola hasn't really gotten the same treatment, and that's why I think there's potential for this. I think investors could sink their money into this. But that's it for Coca-Cola, obviously. We're going to finish it up with talking about, it's a retailer. It's not Walmart. We're talking about Target. Target is a stock that is down year to date, not massively, down around 6.8%. I don't think it necessarily is fairly down. We're talking about Walmart being up quite substantially year to date, when a company like Target's down and performing just as well, but it's down 6.8%. Obviously, when you think about Target, there's a lot to think about. Obviously, on our in-store pickup of goods, they have an online service. You purchase goods, come in store that have already been pulled for you. Someone's pulling those orders, and they can go ahead and deliver it right to your car when you pull up. Very big service right now. You also think about their Shipt partnership, in which they offer same-day delivery. Very big for them. There's a lot going on for Target, and they're seeing some good growth. That's right. I didn't want to have to bring it up, but I'm bringing it up, baby. Target posting a 52 years of growth on the dividends. Dividend king right here. This is the dividend champion. Are you kidding me? 2.25% forward yield right now, just because of the fact that the stock's relatively highly priced. Payout ratio of 53.2, nothing concerning there. This is a very good dividend, and it'll continue to grow in the future. And I mentioned the pricing of the stock, but it's not at all overvalued. Trailing P of 18.8, forward P of 24.8. Nothing's really overvalued with this stock. I think it's at a very fair value. Typically, these retail type companies are going to trade around the 20 the 20 PE ratio range. So nothing's unexpected here. Not a company known for massive growth. We talk about this year posting a 4.5% sales growth. Next year, supposed to do 2.1%. I think it'll be a little bit higher because we think about digital and how digital benefits them. It'll be massive. And as far as EPS is concerned, they're expected to decline this year, not a shocker. 6.39 last year, 5.28 this year. Next year expected 6.91 I should say. So pretty nice. All things considered, it'll be good year-over-year growth, and obviously over a 2-year period it'll be growth as well. But my final point really on Target is going to be the fact that they are rocking digital beyond belief. We look at their earnings call transcript, and I want to highlight this segment here, in which last quarter their digital sales grew more than 40%, or 140%, right? Walmart grew 70%. Target grew 140% in digital sales. And obviously I think they have a couple different metrics that they're probably going to judge this by, but it depends on the company. But this kind of growth is massive, and we talk about the long-term impacts of what we're currently going through. There's going to be a lot more shopping from home. It's just going to be the case. Some people might find it convenient, and if they do, they're going to stop going in stores as much. And they're going to start sticking and using these online shopping things more than ever. And typically people do it for 1 or 2 items for the most part for online shopping. And if they can do that and get it delivered right to their house for free, they're going to be doing it, okay? Especially with a company like Target that offers so many things. It's just going to be good for them. If they provide good customer service, good delivery, they'll get repeats, and this is going to be a massive part of their business as we talk about the growth of online retail. Target is going to be on the forefront of that, in my opinion. They're growing just so well. So these are my 4 stocks for the month. I really hope you enjoyed, and have a great day.